your webinar today, and great to meet everybody. My name is Paul Hopkins. I'm the Director of Acquisitions at CPI Capital. CPI Capital, based out of Vancouver, where we are U.S. multifamily investment firm. So we focus on multifamily throughout the U.S., specifically and hyper focused really in on Florida at the moment. And I'm going to get into reasons why we look at Florida and why we're looking at Tampa specifically. So, and it is a bit about my background. It sounds like a lot of you guys are from, BC and at least the West Coast area. So, I'm originally American, born and raised in Denver, Colorado. But I have been in real estate since I was about 12 years old, starting off with my parents' fix and flips. I fell in love with construction. I went to go work for a commercial contractor. I wanted to be a big developer. And instead of actually working for a developer, I came upon an opportunity to work for a bridge builder. And so I got transferred to Canada pretty much right after college, and I got to work on notable bridges across Canada, including the Port Mann Bridge, the Patello Bridge, Kicking Horse Canyon Bridge, Northeast Stony Trail, also a little bit on Anthony Henday for those that are familiar with Edmonton, Champlain Bridge. So big projects. And I worked on massive estimates, working as a team, putting together these estimates to go out, secure the work, secure the project, or secure the project, and then execute. So I was basically working as a field engineer all the way up to project manager, where I was responsible for estimating a project and then executing on that project. And a lot of what I learned there translates into what I currently do at CPI. So I left that industry back in 2015. And I took an opportunity with a private equity firm out of Denver. So I've been involved with acquisitions and value add and dispositions of multifamily since 2015, where one of my first projects was to do a heavy value add lift on a 315 unit completely vacant property in Dayton, Ohio. So I was basically the project manager of that, set up all the contracting, the subcontractors, renovated all the units, put about $25,000 per unit back into the property, and then leased it up and sold it for a profit. So that's just one example of what I've done. So I've been involved with multifamily throughout the Midwest, Ohio, Kentucky, Indiana, also Colorado, Phoenix, and even in Puerto Rico. So I joined CPI over a year and a half ago as their director of acquisitions, and we set our focus in on Florida because Ava and August, who are the executives of CPI and the founders of CPI, were moving to Florida, and I thought this was a great opportunity to focus in on their backyard. So they reside in Naples, and we decided to focus on Tampa and Jacksonville as kind of like our starting points. And we've been out there, we've toured all the markets, we met with all the brokers, and excited to share more details about this property called Atlas at Bay Point. It's actually called Villas at Flagger Point, but we're rebranding it for a couple of reasons. One reason is that there's a property right next door called Flagger Point Apartments, which gets confusing with vendors and tenants that are looking to lease up here. Another reason that we're rebranding it is because it could use a new name, use a new facelift, new curb appeal. So that's part of the overall business plan. And we chose the name Atlas because that is the son's name, the newborn baby boy of August and Ava. So paying tribute to the family. All right. So, obviously this disclaimers and forward-looking statements. So, and as James mentioned earlier about my underwriting, I do my best to put together our best conservative estimate based on the information and data and research that we know. I've taken a lot of what I've learned over the years from being in multifamily and renovations and going through a few cycles on properties, and also through my engineering experience working on massive projects to put together our forward-looking projections here. So there's a story behind this deal, and I'm going to tell you, what happened. Come early spring of 2023, so last year, this deal was actually on market. It was marketed by CBRE, one of the largest broker firms in the nation, and they're also in Canada as well. They had this property listed for sale, and the original guidance of this property was about 22 million. And CPI submitted an offer at 21 million. We made it to the best and final, meaning that we were one of the few select groups that had the best price and terms to basically do a buyer interview. And unfortunately, we lost the deal to another group. This other group had a higher price than us, and they were awarded the deal. So later on that year, this group, it was a foreign group out of Brazil, and they, for whatever reason, couldn't raise the equity. There were some geopolitical issues that were happening in Brazil, and weren't able to secure enough equity, and so the deal fell apart. The deal came back around to another group that had a relationship with the seller, and they were an affordable housing group, but they weren't able to actually secure the financing for it. And so again, it fell apart. So by this time, it's early 2024 of this year. The deal fell out of contract twice. The broker came back to us and was like, hey, we know you guys, you have a relationship with us. We know that you can execute on this deal. Here's the situation. The seller needs to sell. So the property itself is part of a fund. So the owner is an institutional group out of Boston, and they purchased this property back in 2016. So they've had it for a long time. They've met their business plan, and it was the last remaining property in their fund. And so they needed to close out the fund. They needed to basically return the investor capital. And so they were willing to take pretty much any price as long as we met their terms. And their terms was, we need you to execute quickly. So we came up with a price of 16.85, which is basically a pretty good discount to our original offer of 21 million. And they selected us for the buyer, and we went under contract. So why we love this deal. So of course, we got this at a great basis, locking it up at 123,000 per unit, which is significantly lower than the rest of the average sale comparables in the area of 180,000 per unit, which is about a 30% discount. It's in a very desirable location, positioned in South St. Petersburg. South St. Petersburg, if you don't know where that's at, and I'll show you on a map later on. But St. Petersburg itself is going through a massive gentrification, for one, but redevelopment. The Tampa Bay Rays, which is the Major League Baseball team, their stadium is in downtown St. Petersburg, and that stadium is getting rebuilt. And around that area, there's 86 acres of land that is getting redeveloped as well into restaurants, bars, mixed use, multifamily, and hotels. So big development plan that's going on right now in St. Petersburg. People from Tampa are moving to St. Petersburg. It's a great location. August and I spent, this was about a month ago now, we spent a week in St. Petersburg. Really love what's happening down there, and in all the development, the excitement, and just seeing like the people that are moving to this area. It is a value add play that we have here, meaning that we are going to be renovating the units in order to increase the rents by $175 a month per unit, which is a forced value add appreciation play, which it raises the value by 4.7 million. In addition to that, we are optimizing the expenses. So we're, it's inefficient right now, and we're going to be making it more efficient of an operation. And then there's other items that we're adding in for additional income items. That in combination with the attractive basis that we got this at a discount could potentially increase the value by $13 million. And the last point is we secured very low leverage debt. We had options to go with a higher leverage debt up to about 68% LTV. But the reason that we went with 55% LTV is just because of the recent market volatility that has happened over the last year and a half. There are other syndicator groups or other even institutions this is happening to that over leveraged themselves on debt at 80% LTV and securing variable interest rates. And they're right now in hot water where, there's a lot of investors that are kind of standing on the sidelines because of issues like that. Well, we recognize that. And so we decided, let's go with a lower LTV. We're going with fixed rate debt. And by doing that, we're able to secure financing from Freddie Mac, which is agency loans, similar to CMHC in Canada. And they gave us great terms by going with lower leverage. So they gave us what's known as the spread on top of the 10-year treasury, which the spread is basically their profit margin. So they were giving us a lower spread and full term interest only period of 5 years. So we did that to safeguard our investor capital, and it maximizes the cash on cash return to the investors. So this is a garden style multifamily value add property project, purchasing it at 16.85 million, which is 123,000 a unit for 136 units total. Our expected hold period is 5 years, and I'll explain why we're holding it for 5 years. And this is just a point in time, but I'm going to get into a reason why, but this can also be accelerated. And our expected close date is next month, at the end of next month. These are the investor returns. The IRR is over 17%, averaged annualized returns at 21%. Average cash on cash return is over 7%. The equity multiple of just over 2 times. The minimum investment for this deal is at $50,000, and it's a 506C offering. And that's related to the U.S. securities offering. It is basically allowing us to advertise this to accredited investors only. So we are already at basically 70% committed to this deal. And we're probably actually up to 80% by this point. So we're getting really close to the finish line for securing all the capital to close on time. So this is the team. August Biniaz, Ava Benisaki, the original founders of CPI. Their background is Ava is actually from Fort Saskatchewan, just outside of Edmonton. And she moved to Vancouver, was in real estate as a real estate broker for a number of years. And that's when her and August met. August is a single home developer out of Vancouver. So he was developing spec homes and custom homes. And then they formed CPI over 4 years ago and started investing into U.S. multifamily properties. Seth Ferguson. Seth is also an extensive background in real estate. He is actually the host of Canada's largest real estate conference, which was just last weekend in Toronto, called the Multifamily Conference. You had guests like Robert Hershevek, Elena Cardone, Jordan Belfort, and a few others. So a very successful event. It was about 3,000 attendants, and it's held every year on basically U.S. Memorial Day weekend, which just happened to be last weekend. And then there's myself, Dan Dragonetti, who he's been involved in business. You could see his post-nominal titles. He's got a few of them there, MBA, BCom, and PMP. Honestly, I don't know what a PMP stands for, but yeah, he's got a lot of certificates. And he actually wrote his master's thesis on apartment syndication. And so he's very well acknowledged on real estate and in business. So he's our director of acquisitions. Coley is our dealing representative, meaning that he's in investor relations. And of course, James. He's our general partner in on this deal. A little bit about CPI's portfolio, just under 1,000 units, and 216 million of assets under management. The closest property that we have to this property is Braxton Waterlay in Orlando. So why Florida? Why Tampa? Why St. Petersburg? So Florida it ticks all the boxes for what we look for, what I call uh, uh, essential factors. So there are basically 6 essential factors that we look for: job growth, rent growth, population growth, median household income growth, median household price growth. Um, we also look for high education, which has an inverse relationship to crime. So the crime in Tampa MSA is pretty low. There are over 15 colleges and universities that are in the Tampa MSA area. Of course, it also has it's a landlord-friendly state. It's a business-friendly state. As far as evictions, the eviction laws in British Columbia and Ontario are the complete opposite of what you would find in Florida. And you could evict somebody within less than 30 days if they don't pay their rent. So it's one of the reasons why we look at Florida. And of course, Tampa has, the work-life balance that attracts a lot of people and attracts a lot of businesses. There are 5 Fortune 500 companies that have their headquarters in Tampa. And there's, the airport in Tampa is, ranked #1 in the country. And they also have the largest mega yacht port in Tampa, actually not too far from where this property is located. So trade and transportation is one of the major industries of Tampa. And so a very diverse economy when it comes to jobs. There's not one single employer or type of employment that drives the economy. It's very diverse. Not one category of employer owns it has more than 20% share of the workforce. So it's really diverse. So speaking of diversity in the area, this is a very text-heavy slide, but just wanted to show at least what the overall employment opportunities look like for the Tampa MSA. Atlas at Bay Point is located in South St. Petersburg down here. And it's about 15-minute drive up Interstate 275 to downtown St. Petersburg, where you got 28,000 employees. You also have major hospitals like St. Anthony's Hospital, Johns Hopkins Hospital, and Bayfront Health. And about 20 minutes away, you've got the Gateway Business District, where it has 114,000 employees. You're 30 minutes to downtown Tampa, 30 minutes to the airport. And then to the south of the property, down 275, 45 minutes away is downtown Sarasota. And so there's quite a diverse range of jobs and employment that are in the area. So not just jobs and employment, but you also have the work-life balance. So just within 15 minutes of the property is St. Pete Beach, which is the #1 beach ranked in the US and #5 in the world, according to TripAdvisor. And then many other people know about Clearwater Beach. Clearwater Beach is about 30 minutes away, but all along the coastline here, just beautiful beaches and great entertainment. Of course, there's golf and anything else that might attract a lot of people. They don't have skiing. That's the only problem. But everything else is a great economic driver for Tampa. So let's talk a little bit about rent growth. So the average rent at this property, Atlas at Bay Point, is at $13.76, which is represented by this light blue line right here. The average rent in South Pinellas or South St. Petersburg is this represented by this yellow and green line right here, which is about $16.30 per month. And the broader market, which is the Tampa MSA, is this dark blue line here at 1770. So there's a term that is in real estate called loss to lease, and it's basically the loss of what the market rate is, what the current in-place rents are versus the market rent. And there's about a $300 difference in your loss to lease opportunity compared to the market. So that just right there shows the potential of where we can push our rents to meet the sub-market rents. You'll notice later in my underwriting that we don't get there. We're not at 1,600. Okay. And we're staying below that. So also to note, St. Petersburg is actually one of the strongest submarkets in Tampa MSA. And the reason I say that is because this year, well, at least over the last year, rents have declined across the nation and in certain markets within Florida. There was obviously a big spike that happened. This was a trend that you see in most major markets in the US and specifically Florida because people were moving to Florida during COVID. And so in 2021, there was a huge spike. This bar graph down here, this bar graph represents the rents growth year over year. Okay, so there was a huge rent spike up to 20%, and then it cooled back down. In other markets in Florida and across the US, it actually went up so high and it cooled off so quickly that it went actually negative. So it needed to rebalance itself, where St. Petersburg, it did cool off, but it didn't go below zero. And so this graph here is from CoStar. CoStar is an analytical software program that's specific to real estate. They own apartments.com. They own LoopNet. And so they've got a lot of data. And they also have hundreds of analysts that work for CoStar. And they're putting all these projections together. And so CoStar is projecting that the rent growth for 2024 was going to be about 2.5%, climbing up to 4%, and then down to 3.5%. And we're actually staying below that in our projections. So for 2024, our rent projection is 1.5%, and then we're staying at 3% thereafter to basically be just below the historical norms of rent growth. So staying at the 3% mark. I will say though, when I did my underwriting, and these numbers are all based off of information that we got back in March. So I used the rent roll to determine a lot of the potential rent growth. And the rent roll that we had in March compared to the rent roll that we have from just recently in May, there has already been a 4% increase in rents. We are already achieving rents on our 2-bedroom units. So that right there is proof in the pudding that we are able to achieve the rents. There are already units that are renting at our pro forma rents. So this is just an exciting moment that when we saw this, that yeah, these are actually numbers that are true and actually happening. So good to report that. James talked a little bit about this, and I'm explaining it here with visual aid. I'm more of a visual learner, and I figure pictures are worth 1,000 words. So this is what we call our capital stack. At the base here, we've got our debt, which is 55% loan to value, which equates to $9.2 million. The remaining equity is coming from limited partners or investors, and our general partnership. So we have our general partner, which is CPI and the team. We're putting actually 10%, so just over $1 million into the property, and the remaining $9 million coming from limited partners. So there's an 8% preferred rate of return, meaning that the 8% is due to the investor first, and if that 8% is not being able to achieve, then it gets accrued. Once that 8% has been met and the return of principal has been paid, then it's a 75-25 split. So 75 of the profits are giving to the limited partners and 25 to the general partner. So why are we going with a lower LTV of 55%? I did explain this a little bit more, but here's some additional bullet points for you. So it aligns with our commitment to safeguarding our investor capital and maximizing their returns. It shields our investors and us as partners from the market volatility and securing a long-term investment growth. Using the lower leverage, we were able to get great terms from Freddie Mac, which was the full term interest only, and a fixed period for 5 years. This also enhanced the cash on cash returns, which cash on cash is gold. Cash on cash is very reliable when it comes to analyzing properties and investment properties. And like I always say, is you can't eat IRR. IRR is a projection of what the performance could be, and it's a speculation. Where cash on cash is more true, and you can basically have more of a consistent paycheck based on cash on cash instead of IRR. So this is the projected investor returns. Again, this is the table breakdown. I've showed this earlier on another slide, but 75-25 split, 8% preferred rate of return, equity multiple of just over 2, 21% average annualized return, or 17% IRR. So based on a hypothetical $100,000 investment, year one, the projection is at 4,725 or 4.7%. Followed by year two at 7.1, year three, 8.3, 9.5 in year four, and 9.8 in year five. And we're basically achieving the 8% preferred rate of return within year three. The cash on cash totals up to just under $40,000. And then with the sale, the profit from the sale of 165, totaling the 205, which is your 2.05 equity multiple. So if we were to absolutely do nothing to this property and we just let it perform as is, basically the cash on cash would be this. I also have sensitivity analysis. The cash on cash would be at the minimum of 4.7 if we did absolutely nothing to this property. I do have sensitivity analysis that are available, and that shows, if there was no rent growth, what the IRR and AAR returns are. If the exit cap was different, higher or lower, or if the time period for the sale was shorter or longer. So in all cases, cash flow remains strong and the returns do remain strong. That's how we stress test it. Property specifications. So it was built in 1972, sits on 8.6 acres, which is basically like a city block that it sits on. Total of 7 buildings. It's concrete block on a concrete slab with stucco exterior, copper wiring, cast iron drainage, and individually split AC units. And I'll get into the project amenities and unit amenities here on the next couple slides. So the unit mix, it's so a total of 136 units, average square foot at 787, average in-place rents at 1376. So it's a good mix of 1-1s, 2-1s, and 2-2s. There are no micro units. There are no 3-bedroom units. And a testament as to the demand for this area is when we first underwrote the property, we were using the occupancy was at 94.5%. The property is currently at 99% occupied. So there's probably a couple of reasons why it's such at a high occupancy. One is because the rents are low and it's attractive, and two, it's because these units are desirable for this type of tenant and demographic. The units do include LVP flooring and carpet in some units. The seller has owned this since 2016, and they've put about $6 million of CapEx into this property over the last 8 years. And they basically gone in and renovated all or 98% of the units to what we call sibling modern. So they replaced all the kitchen cabinets, the countertops, replaced all the appliances with stainless steel appliances, and they did some hardware replacements as well. They spent some money as well on the amenities. where they improve the garden that you walk down to get to the leasing office. Very mature trees that are on the property, offering a lot of shade. And then you've got the leasing office, community center, and just off to the right here is the fitness room with newer equipment. And then behind the leasing office and fitness room is the swimming pool, which had been recently resurfaced. Every unit includes a private patio and a balcony. For the interiors, this is a good representation of what the units actually look like. So a month ago, we walked every single unit. During our due diligence, we wanted to ensure that, what was represented to us or disclosed to us was accurate. So we walked every single unit. We took note of any damage, the condition of the property, and then basically put it on a matrix so that we can keep track of it year over year, or when we close on it, actually. So the conditions are actually in really good shape, but there are some rooms for improvement that we see that we can allow us then to increase our rents by $175. So that's including ceiling fans in the bedrooms, adding backsplash to the kitchen area. We're upgrading all the electrical or all the lights to LED packages, replacing all the doors with new doors and hardware. And we're adding washer dryer connections and the machines to all the 2-bedroom units. So that's 60 units in total. And then we're updating the electrical and plumbing fixtures as needed. As far as the exterior, so this is where a lot of our focus is going to be on, is going to be that curb appeal. So we have $1.1 million set aside to do exterior painting, landscaping, new monument signs, basically rebranding the property, additional exterior lighting, the roof replacement, knee wall replacement, pool furniture, and optimizing the laundry rooms. And so when I say the knee wall or mansard roof replacement, that's this feature that you see right here. So this is a picture of Atlas at Bay Point. And then this is a rendering of a property that's nearby that recently got renovated. So they replaced this knee wall with a more of a modern railing feature, which is really nice. And then the lighting and unit numbers outside each of the unit doors is something that we're going to be doing as well. So we're adding lighting and the unit numbers to each of these doors, new paint schemes on the outside. We're also adding light to accent these walls here. So lighting up top or down below. It'd be nicer to have it down below. But at worst case, we'll have the lighting up here and casting the light on these walls. The roof replacement was probably the biggest cost, or is the biggest cost as far as our exterior CapEx. So $650,000. We had about 15 roofing contractors come out to the property. Some of them were out there when we were doing our due diligence. We got up on the roof. We took a look at what was going on with the roofers. And then the price that we had initially in our budget of $640,000 was actually a quote that we received from one of the first roofers. And we received other quotes that were around that same number. So we're confident in that price too. Now, we found free real estate during our due diligence, and there's a couple things here that I want to break down for you. Since we are adding washer dryers to all the 2-bedroom units, we're going to optimize the existing laundry rooms. There are 14 laundry rooms on the property that look like this. There's a single washer and a single dryer. So there are 7 buildings, and there's 2 floors on each building, and each building on each floor there's a laundry room. Because we're adding in these washer dryers into the 2 bedrooms, it's a chance for us to optimize these laundry rooms. But what we didn't know is right next to these laundry rooms was a maintenance shop. So on the ground floor, they're actually using these maintenance shops for storing their tools and lawn mowing equipment. But on the second floor, it was vacant, completely idle, and nothing that was in there. So they share a wall between the laundry room here, the storage unit, and the laundry room share a wall. So we can knock down this wall and add in another unit. It would be like a studio or a smaller 1-bedroom. but we're already at maximum density on this property. And so we wouldn't be able to, simply add in these additional units without having to jump through a bunch of hoops and permitting. And that takes a lot of time. Plus, the cost to add in another unit is at least $75,000 to do that. Where the easiest solution and the quickest solution to get cash flow going is adding in storage units. And so we see that with just optimizing these 7 idle rooms, not optimizing the laundry rooms yet, but optimizing these idle rooms, the 7 of them there, we could probably fit about 10 storage units that are 4x4, charging $2 a square foot. That additional revenue equates to about $500,000 in additional value. I did not include this in my underwriting. This is a cherry on top. This is additional cash flow above and beyond what you already see here in my underwriting. So this was a great find, and we're excited to basically discover this free real estate. And then, of course, with optimizing the laundry rooms, it gives us more opportunities to add in either additional amenities or additional storage. So we're first going to use these idle maintenance shops to put in storage units. We'll see how well that does, and then we're going to optimize everything else after that. So there's a lot of numbers on this slide, but I'm not going to go through every number, but I do want to highlight a few things for you. So this first column right here represents the trailing 12 financials. What did the last 12 months look like for income and expenses for this property? And then this is our year 1 pro forma. If you look at the effective gross income last year, the effective gross income for the property was 2.4 million. Our year 1 pro forma is at 2.3, which is a negative 3% growth on the effective gross income. The reason being is because if you look at the economic loss of 81,000, we're taking it up to nearly $230,000 economic loss. We're factoring in a higher vacancy. We got renovation vacancy. We've got more concessions. As you renovate a property, sometimes you have tenants that do leave. And then you may need to offer concessions to bring more tenants in. So we've factored that in. We're assuming that it's going to be a higher economic loss to the property as we renovate. But over time as well, you could see that I've kept that number close to the same. It goes higher in year 2 because we have more vacancy from the renovations. A lot more units are being renovated. And then it tapers back down. But we're still higher than the original. So, we're shooting low, and hopefully that's where our economic loss is going to actually be improved and be close in line with what's currently there. The other thing I want to point out is the operating expense ratio and the operating expenses per unit. Currently, the operating expense ratio is at 59%, and we're bringing it down to 52%. In this submarket, and then for this property, we should be operating between 45 and 50%. So we're staying above that 50% by going to 52% in year 1. And then as far as the expenses per unit, if you look at, I've collected a lot of data from Florida, and specifically based on the age of the property, the number of units, the location of the property. We should be somewhere around $8,500 per unit in operating expenses. They're currently at $10,500, and we're staying above that $8,500 in year 1 and through the entire pro forma. So the other things that I want to point out is the cap rate on purchase at 6.63. The market cap. So there's different cap rates that we could dive into, but quick high level, this is the purchase cap rate at 6.63. When you compare this to the market, what is properties typically selling for in Tampa and in St. Petersburg, specifically St. Petersburg? The market cap is about 5.5%. So that right there just shows you that we're getting this property at a discount compared to the rest of the market at 5.5%. Our exit cap, if you remember on one of the first slides, is at a 6%. So we're assuming that the economy is basically the cap rates are expanding and the economy is not performing. And so it's a 50 basis points over the 5 years. So 10 basis points per year of expansion that we're using in our underwriting. We're hoping that's not the case. We already see that population growth is positive. People are continuously to move there. Jobs are continuing to come there. Companies and employers are moving there. And so the economy is doing very well. And so, we're doing as far as our exit cap projections at 6%, feel that's a very comfortable level for us to be at in our exit cap projections. The other item I want to point out is our break-even occupancy. So this basically means what occupancy can we be at in order to maintain paying our mortgage. And so it's under 80%. So we can have a 20% vacancy on this property and still be able to have enough cash flow to pay our debt. One bedroom comps. So I've sorted this from high to low. And what I want to point out here, Atlas at Bay Point, the in-place rents right now for the one bedrooms are at $1,250. And our pro forma rents are at $1,350, where the average above here of all the properties is at $1,332. So what I do want to point out though is we're going to be in the top tier of these properties. But Flagler Point Apartments, which is the property right next door, it was also owned by the same owner and has the same level of finishes, and they are already achieving 1537. We're not sure why the seller was not able to, or why they did not even increase their rents to get to these levels. But that just shows you that we have, I'm staying underneath the current projections and being competitive in this market behind these other competitors here for the one bedroom. Now for the two bedroom, the Atlas at Bay Point in place rents at $1,535 and the pro forma at $1,805, where the average is at $1,667. Now you may think, well, that's a much bigger spread, and it is. It is a much bigger spread than the one bedrooms, and there's a reason for that. It's because we're adding washer dryer units and machines into the two bedroom units and including that into our monthly rent. And the reason that we did that was because when you look at Flagler Point Apartments, the Morgan, and the Enclave, most of their units, most of their two bedroom units have washer dryer connections. Some of them don't have washer dryer connections, and not all of them have the machines included in their rent. But these units on average are renting at $1,950, $1,875, and $1,795 with washer dryer connections, and in some in the units. We're offering washer dryer connections and the machines within the rent to justify that $1,805 rent. So we're still below the Flagler Point, and we're still below the Morgan. Now, looking at sale comparables, one of the biggest pushbacks that we initially had on this property was the age of 1972. So I dug into it a little bit more and doing a lot of research about, the market. What happened in 1960s and the 1970s? Well, there was a big boom in construction and apartment building in the 60s and 70s, and then it tapered off in the 80s. So 1960s and 1970s apartments account for over 25% of the market. So there's a big chunk of properties that are in that vintage. And we also wanted to see, are they selling? Buying a 1972 deal today is almost like buying a 1960 deal in the next 5 years. So what is selling for 1960s deals? So I took a look at all the properties that have been sold over the last 2 years around 1960 to 1970, with a few 80s properties in here as well, that were comparable, of similar property size and shape and landscape and structure. Came up with 15 properties, average age of 1973, and the price per unit of $182,000, where we're buying this one at 123,000. And most recently was Oasis at Bayside, which is a 1984 property just down the street that sold for 168. And Lofts at River's Edge, also about 15 minutes from the property, in 1964 that sold for 170,000. And then another 73 deal, Flagger Point Apartments, the property right next door, sold for 168 a unit. So we scoured, the two biggest factors and two biggest risks, I should say, two biggest risks in apartment investing is your property manager and your construction manager. So we wanted to make sure that we had the right property manager on board with us. And so we scoured basically all of Tampa. We've interviewed lots of different property management companies. And we actually have a relationship with WPG. We've known them for several years and had many opportunities to actually tour some of the properties that they've managed. They're also owners of some of the apartments that they own. They have a portfolio of over 1,500 units in Tampa MSA with one of their properties is 15 minutes from Atlas at Bay Point and performing really well. We've sat in their office, we've seen their operations, and are very pleased to have them as our property management company. So, in summary, we're buying this at 123,000 a door versus the 180,000 in sale comparables. Great location within St. Petersburg. A very simple value add opportunity to increase rents and increase the value up to 4.7, plus the overall operational efficiencies that we see. Adding in additional income items and increasing the overall value from purchase of 13 million. Securing a very low leverage debt of 55%. We have experience in this market. We have a very strong property manager. We have an existing portfolio. And of course, we have residents. Basically call it our backyard. It's an hour and a half away from Naples and where August and Ava live. And also, a big concern with a lot of other investors is what about insurance? So insurance, a year ago, when we looked at insurance on this property, we were getting quotes of around $2,250 per unit per year. And that is very expensive when you look at other markets across the US. The reason that it was so expensive is because there were at one point several insurance carriers. And then a few of those carriers left, and there were only two, and it became a monopoly. However, as of January of this year, that one of those carriers that left came back into the market and made it extremely competitive. They're back in the market and have a good appetite. And so our initial quote of 2,250 came down to 1,200, so half of what it was originally. But what we're also doing is we're putting it on our master insurance policy, which spreads the risk across all the properties in our portfolio, and then so that it's not so isolated if there is a hurricane. Okay. Another thing I didn't talk about too much now that we're on the insurance topic is hurricanes. Where this property is located, it's not in a flood zone, and it's at an elevation of 30 feet, which doesn't seem like much to many Canadians, but it is in Florida. It's concrete block. It's been there for over 50 years and pretty well kind of sheltered property. So hurricanes aren't a concern to our insurance provider, and it has stood there for the test of time as well. So we're quite confident in the stability of the property for that reason. And we're also in our underwriting, we're setting aside 4 months of operating expenses as a cash reserve for anything that might come up. That's an extra $400,000 that we're setting aside in an account for, mistakes or contingencies. So that's also included in our underwriting. So that's my presentation, and I put up a QR code here if you wanted to scan this to basically scanning this code will get you into a soft commitment form. That soft commitment will then allow us to understand, first of all, that you're interested, who you are. And it allows our team, James and Ava, to reach out to you and provide you with any more information. And I'm also going to put in the chat. So this is my underwriting model, and just I'll quickly go through my underwriting model for you. This is I've broken everything down in my underwriting, from the how we're structuring the deal, our unit mix, the timing. I just realized actually there was a few slides that are missing off of this, so my apologies. I didn't actually talk about the sources and uses. Hold on, let me give me 1 second. I apologize. There's something that's missing that is important for you guys to know, and I'm sure it will come up in a question. Just 1 second. Here we go. Timeline. So we're buying this at the end of June. We're going to spend the next 6 months focused on the exteriors and completing the exteriors by the end of this year. And then we're renovating all 136 units over the next 45 months, which is 3 units per month. So the reason that we chose 3 units per month, it's a very slow velocity when you look at, the entire property size is 136. So the reason that we did that is we looked at the slowest month for lease renewals. And on average, it was about 5 to 6 lease renewals during the slow months. So if we assume that 50% of the tenants stay and the other 50% leave, well, that's 3 units per month. And so that was the base point. We're going to look at, only 3 units per month. We can obviously accelerate that. We can go up to 10 units a month based on some of the leases that are expiring. And our contractor and construction team have the ability and manpower to do that. They are light renovations. And so we could actually go into these units. We're able to do the renovations within a week and then have that property remarketed during that renovation period and have it tenanted within a month period. So with the renovation velocity of 3 units per month and the renovation vacancy of basically 1 month, that's also accounted for in my underwriting. Now, here we go. Oh, I went too far. Sorry. Sources and uses. So again, a breakdown of the cash. So our senior debt at 9.2, GP equity coming from the GP team of $1 million, and the LP equity of 9.4 for a total of 19.7 million. So if we break that down, that 19.7 million, it's the purchase price of 16.8, our financing fee with the lender of 92,000, closing costs of 421, which is about 2.5% of the purchase price, our acquisition fee of 337, interior capex and exterior capex, which also includes our GC fee, and 4 months of operating reserves of $411,000 for a total of 19.7. As far as the fees included in the underwriting, it's a 2% acquisition fee, a 3% asset management fee, a 3% property management fee, and then the 5% construction management fee. The property management fee and the construction management fee is going to a third party and not the general partnership. We have not structured in a loan guarantor fee or a disposition fee. So apologize that I missed that on my slides here with James, but wanted to kind of show you high level of my underwriting model here. And what I've also done is I've done a deep dive analysis into my underwriting model, and I've recorded that. And I'm going to paste that in the chat here. And you guys are all welcome to jump onto this as soon as I find it here. You're all able to jump into my video, watch how I underwrite this property. I might answer some of your other questions if you love numbers and if you want to nerd out, this is for you. So I'm going to put that in the chat right here. But I go through this whole thing. Uh, I also offer this model to you to take a look at and see how we've structured everything as far as like our growth, how we're assuming rent growth, expense growth, real estate taxes, etc. On the topic of real estate taxes, another thing that is another cherry on top. So I have, as far as figuring out the taxes, taxes are based on usually the acquisition price and an assessed value. Historically, the assessed value is about 70 to 75% of the acquisition price. So I've used 80%. I went up a little higher, applying the millage rate to come up with our annual tax burden of $267,000. What we have done is we're consulting with a tax lawyer for a tax strategy that has been very effective in the state of Florida and other states. It's completely compliant with all SEC, IRS laws, and anything else. So what we're doing is we actually separate out the tangible versus intangible value of the property. And what gets recorded on the deed is the tangible value. So it's a reduced value that gets assessed by the assessor. And if we use this strategy, our year one tax rate drops down from 267 to 222. So on average, though, if you look at every year and what they're projecting as our tax payments every year, it's about $60,000 less per year on average that we would be saving. So that is an additional cherry on top of this underwriting, where it provides more cash flow to our investors. So I explained that a little bit more in the different levers that that other syndicators can pull. This is exactly what James was talking about in the very beginning of the presentation. But I'm providing my full underwriting to you so that you can dive into it, see how I made these assumptions, why I made these assumptions, and then where basically the conservative underwriting number, or I know it's a cliche to say that it's conservative, but how I looked at the overall projections. So with that, I will stop talking and put this slide back up here.
Thanks so much, Paul. Now, this QR code, guys, I'll just give you a link in the chat to where that QR code goes. This presentation was, I think, also designed to be presented live in person for people that wanted to scan a QR code with their phone, but you're all just watching from the comfort of your homes. So the link that QR code goes to, I just put it in the chat. So essentially what I'm going to do is I'll share with you what you're going to see when you follow that QR code, just so that you have an idea of what we're talking about here. So they've made a really nice online portal to review all of the information that has to do with the entire deal, the transaction, everything. We've got photos, we've got all kinds of additional pieces of information that you can look through, a recording of this presentation just that they've delivered. Obviously, they've been delivering this presentation to a lot of folks. So it just breaks it all down. If you want to schedule a follow-up conversation because you are interested and you want to go deeper, obviously schedule a call. If you want to figure out what the next steps are for investing, just click the Invest Now button. So it's all pretty straightforward. And of course, I'll follow up with everybody and just do a friendly call to see what you guys thought.